Hello everyone and welcome. Today we're diving into the exciting world of dividend growth investing. Imagine a strategy where your investments don't just grow, they shower you with a steady stream of passive income. That's the magic of dividend growth investing, and it can be your secret weapon to building long-term wealth. We're going to break down this powerful approach, exploring how it works and why it might be the perfect addition to your investment portfolio. Whether you're a seasoned investor or just starting, this video will equip you with the knowledge to harness the power of dividends. Ready to unlock a world of financial freedom and watch your wealth grow? Let's get started. We'll delve into the ins and outs of dividend growth investing, providing you with valuable insights and actionable strategies. Get ready to transform your investment journey and embark on the path to financial success. What exactly are dividends? Simply put, they're a share of a company's profits distributed to its shareholders. Think of it as a thank you for investing in their success. Companies doing well often share profits with investors. Not all companies pay dividends. Some reinvest all profits back into the business. These are growth companies. Dividends are typically paid in cash, directly to your brokerage account. They can provide a regular stream of income. You can choose to reinvest. This helps your investments grow faster. Dividends represent a tangible return on investment. Unlike stock prices, which fluctuate, dividends offer a level of predictability. They reflect a company's financial health and commitment to its shareholders. This makes them attractive for long-term investors. Dividend growth investing takes the concept of dividends a step further. Instead of just focusing on companies that pay dividends, we seek out those consistently increasing them year after year. Why is this so powerful? It's all about the magic of compounding. Imagine a snowball rolling downhill. As it rolls, it picks up more snow, growing larger and larger. Dividend growth investing works similarly. When a company increases its dividend, you receive a larger payout. Reinvesting those increased dividends allows you to buy more shares, generating even more dividends in the future. This cycle of increasing dividends and reinvestment creates a powerful compounding effect, accelerating your wealth-building journey. Over time, even small dividend increases can have a significant impact on your portfolio's growth. Dividend growth investing is a long-term strategy. Now that we understand the power of dividend growth, how do we identify companies poised for consistent dividend increases? The key is to look for companies with strong earnings growth. Growing earnings signal a company's ability to sustain and increase dividend payments. Low payout ratios. This metric shows what portion of earnings is paid out as dividends. A low payout ratio suggests room for future increases. Solid financial health. Look for companies with strong balance sheets, manageable debt, and a history of profitability. By focusing on these factors, we can identify companies with a high likelihood of increasing dividends over time. We'll explore this further in the next section. Investing in companies that consistently increase their dividends can help protect your portfolio from the erosive effects of inflation. Inflation erodes purchasing power over time, but dividends can help offset this. When a company increases its dividend, the increase often outpaces the rate of inflation, helping to maintain the real value of your investment. Dividend growth investing provides a hedge against inflation. By investing in companies with a proven track record of dividend growth, you position yourself to potentially outpace inflation and grow your wealth over the long term. In the next part, we'll delve into specific strategies for selecting dividend growth stocks and building a robust portfolio. One effective strategy for identifying companies with a strong track record of dividend growth is to focus on the Dividend Aristocrats. This prestigious group consists of companies within the S&P 500 index that have increased their dividends for at least 25 consecutive years. That's right, a quarter century of consistent dividend growth. These companies have demonstrated a commitment to rewarding shareholders through thick and thin. They have weathered economic storms and market downturns, emerging stronger and continuing to increase dividends. Investing in Dividend Aristocrats provides a level of confidence and stability. While past performance is not indicative of future results, the Dividend Aristocrats list serves as a valuable starting point for identifying companies with the potential for continued dividend growth. It's a testament to their financial strength and management teams committed to shareholder value. While the Dividend Aristocrats list is an excellent resource, don't limit yourself to just those companies. Many other companies have impressive track records of dividend growth, even if they haven't reached the 25-year mark yet. Look for companies with a solid history of dividend increases, say 10 years or more. These companies are often referred to as dividend contenders or dividend challengers. They may offer even greater growth potential than some established aristocrats. Remember, diversification is key to a successful investment strategy. By including companies at various stages of dividend growth, you create a more resilient portfolio with the potential for both current income and future growth. When building a dividend growth portfolio, it's essential to diversify across different sectors of the economy. This reduces risk and can enhance returns. Different sectors perform differently under various economic conditions. For example, during periods of economic expansion, cyclical sectors like consumer discretionary and industrials tend to outperform. In contrast, defensive sectors like consumer staples and healthcare are more resilient during economic slowdowns. By investing in companies across multiple sectors, you create a more balanced portfolio, less susceptible to the ups and downs of any single industry. This diversification strategy helps mitigate risk and enhances long-term growth potential. While dividend growth investing is a powerful strategy, it's crucial to remember that valuation still matters. Just because a company pays a high dividend doesn't necessarily mean it's a good investment. A high dividend yield could indicate a company's stock price has declined, potentially signaling underlying problems. Always conduct thorough research, analyze a company's financials, and consider its growth prospects before investing. Look for companies with a history of dividend growth and a reasonable valuation. This approach combines the power of compounding dividends with the potential for capital appreciation, maximizing your returns over the long term. In the next part, we'll explore real-world examples of successful dividend growth investments, providing you with tangible insights into this strategy's potential. Let's delve into the world of Dividend Kings, an exclusive group of companies committed to dividend growth. To earn the title, a company must increase its dividend payouts for 50 consecutive years. That's half a century of dedication to shareholders. These companies epitomize dividend growth investing. They navigate economic cycles and market fluctuations, rewarding shareholders with increasing income. Consumer staples companies are known for their resilience and consistent dividend payments. They produce essential goods and services that people use daily, such as food, beverages, household products, and personal care items. Even during economic downturns, people still need to eat, drink, and take care of their families. This consistent demand provides consumer staples companies with a level of predictability. Investing in consumer staples companies can provide a sense of security and stability to your dividend growth portfolio. The healthcare sector is fertile ground for dividend growth investors. As the global population ages, demand for healthcare services rises, positioning companies for long-term growth. From life-saving drugs to innovative medical devices, healthcare companies are vital, making them attractive investments. The healthcare sector is resilient during economic downturns. People prioritize health, ensuring steady demand for healthcare products and services. This translates into predictable cash flows, enabling sustained and increased dividend payments. Investing in healthcare companies with strong dividend growth provides stability and growth potential. As the sector innovates and expands, so can your dividend income, contributing to a healthier financial future. Traditionally, technology companies have been associated with rapid growth and innovation, often reinvesting all their profits back into research and development. However, as the technology sector matures and some companies reach a certain size and scale, they have begun to embrace dividend payments as a way to reward shareholders and attract a broader investor base. Today, several technology giants are recognized as dividend aristocrats and contenders, consistently increasing their dividend payouts year after year. These companies have demonstrated their ability to generate substantial cash flows, allowing them to invest in future growth while also returning value to shareholders through dividends. Investing in technology companies with a history of dividend growth provides exposure to the dynamic world of innovation while enjoying the benefits of passive income. As technology continues to shape our lives, these dividend-paying tech titans offer a compelling combination of growth and income potential for long-term investors. The relationship between interest rates and dividend-paying stocks can significantly impact the attractiveness of dividend growth investing. When interest rates are low, investors often turn to dividend-paying stocks as an alternative source of income. This increased demand can drive up the prices of these stocks, potentially leading to higher valuations. Conversely, when interest rates rise, investors may find fixed-income investments like bonds more appealing, as they offer a guaranteed return. This shift in investor sentiment can put downward pressure on dividend-paying stocks, potentially leading to lower valuations. Understanding this dynamic is crucial for dividend growth investors. By monitoring interest rate trends and adjusting their investment strategies accordingly, they can potentially capitalize on favorable market conditions and mitigate potential risks. Periods of economic expansion often create a favorable environment for dividend growth investing. As the economy grows, businesses tend to generate higher profits, providing them with more resources to invest in growth and reward shareholders through dividends. During these times, companies may be more likely to initiate or increase dividend payments, making it an opportune time for investors to seek out dividend growth opportunities. Moreover, economic expansion often leads to increased consumer spending, which can benefit companies in various sectors, particularly those in consumer discretionary, industrials, and technology. As these companies experience revenue growth, they may be more inclined to share their success with investors through higher dividends. Dividend growth investors can leverage economic indicators like GDP growth, unemployment rates, and consumer confidence to gauge the health of the economy and identify potential investment opportunities in companies well-positioned to benefit from economic expansion. During periods of inflation, the purchasing power of money erodes, meaning you can buy less with the same amount of money. Dividend growth investing can act as a hedge against inflation, helping to preserve the value of your investments and maintain your purchasing power over time. Companies that consistently increase their dividends are often able to pass on rising costs to consumers by raising prices for their goods and services. This ability to maintain pricing power during inflationary periods allows these companies to protect their profit margins and continue growing their dividend payments, even as inflation erodes the value of currency. By investing in companies with a history of increasing dividends at a rate that outpaces inflation, dividend growth investors can potentially stay ahead of the curve and protect their portfolios from the erosive effects of rising prices. Market volatility is an inherent part of investing. Stock prices can fluctuate significantly in the short term due to various factors, such as economic news, geopolitical events, and investor sentiment. During times of market turbulence, dividend-paying stocks, particularly those with a long history of consistent dividend growth, can provide a sense of stability and act as a safe harbor for investors. While stock prices may fluctuate, dividends offer a tangible return on investment that is less susceptible to short-term market swings. Companies with a strong track record of dividend growth have demonstrated their ability to weather economic storms and continue rewarding shareholders, even during challenging times. Dividend growth investing can provide a sense of calm amidst the storm of market volatility. By focusing on companies with a proven track record of dividend growth, investors can potentially mitigate risk, ride out market downturns, and emerge stronger on the other side. Dividend growth investing offers a compelling combination of benefits for long-term investors. Participate in the growth of successful companies while enjoying a steady stream of passive income. Watch your dividend income grow year after year, providing financial security and freedom. Reinvest those dividends, fueling portfolio growth and accelerating financial independence. That's the power of dividend growth investing. Select companies with a proven track record of dividend growth and diversify across sectors. Make your money work for you, generating passive income and creating a brighter financial future. Now that you understand dividend growth investing, it's time to take action. Research companies with a history of dividend increases and explore different sectors. Consider your investment goals and risk tolerance. Knowledge is power. The more you learn, the better equipped you'll be. Start small and build your portfolio over time. Stay consistent and reinvest your dividends. Allow compounding to work its magic. The world of dividend growth investing awaits. Embrace this opportunity and watch your wealth flourish. Thank you for joining us.